Hello, my name is Edmond Jamna, and on behalf of DW Consult, I want to welcome you to Tutorials on the Go. Our zeal here is to help transition people with zero, struggling, or shaky base in accounting to an expert position and to a place of confidence. It is also a platform to assist in the smooth studying of the ACCA and ICA professional qualifications, as well as for any tertiary accounting discipline. All that is required of you is to subscribe to our channel and click on the notification bell as well to be part of the program. Tutorials on the Go, bringing accounting to heart. Now to this episode's lecture. Revenue from contracts, Ifrs 15. Now the objective is to establish the principles that an entity shall apply to report useful information to users of financial statements about the nature, amount, timing, and uncertainty of revenue and cash flows arising from a contract with a customer. The core principle of Ifrs 15 is that an entity will recognize revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. Now let's look at some terminologies. The first we'll look at is revenue. Now this is an income arising in the course of an entity's ordinary activities. The next is a contract. It is an agreement between two or more parties that creates enforceable rights and obligations. A party that has contracted an entity to obtain goods or services that are an output of the entity's ordinary activities in exchange for consideration is a customer. So let's take a look at the steps in which it's necessary to identify a revenue. The first is that you have to identify the contract with the customer. Secondly, you identify the performance obligations in the contract. Thirdly, you define the transaction price. Then you allocate the transaction price to the performance obligations in the contract. And lastly, you recognize the revenue. We're going to take a look at the elements one after the other. We'll start with identifying the contract with the customer. Now, the contract must have been approved by the parties involved. So normally there should be an offer and an acceptance to the offer made. The right to each party in relation to the transfer of goods or services should be identified. The payment terms for the goods or services to be transferred can also be identified. The contract must have commercial substance, meaning it should be viable on the market. And lastly, it is probable that the consideration to which the entity is entitled to in exchange for the goods or services will be collected. In other words, revenue will be collected in most probable terms. The second criteria is identify the performance obligations in the contract. Performance obligations are promises in the contract to transfer to a customer goods or services that are distinct, means that it can be sold or transferred separately. Now, if the goods or services that have been agreed to be exchanged under the contract are distinct, then they should be accounted for separately. Let's illustrate how identifying performance obligations will look like. So Optech Limited is a business that primarily sells air conditioners. So as well as selling air conditioners, it also installs and provides a technical support package over a number of years. And the business commonly sells the installation and technical support in the combined goods and services contract. So here, the sale of the air conditioner is one performance obligation. The combined goods or service contract has two separate performance obligations, which is the installation of the air conditioners and the technical support. So we have three performance obligations here. The third step in identifying the revenue is the determination of the transaction price. Now, the transaction price is the amount the selling party expects to be entitled to for transferring the promised goods or services to the customer. So the transaction price is affected by significant financing components. So the transaction price must reflect the value at the date of transfer of the promised goods or services. So when there's a timing difference between when the consideration is received or will be received and when the transfer of goods or services will be made, then the significant financial component is at play here. So if the payment is made in advance, the entity is deemed to be benefiting from the financing, or it is deemed to have borrowed funds from the customer. So the transfer price must be adjusted upwards to capture the interest to the transfer date. The interest, on the other hand, will be captured as an expense. Alternatively, if the payment is received in arrears, the entity is deemed to have provided finance to the client. So in this situation, the price must be discounted to the date of transfer. Now, significant financing is absent if the difference in timing between the consideration and the transfer is less than 12 months. Also, if payment is made in advance and the delay of transfer is at the discretion of the client, then significant financing is not at play. The other factor that can affect the price is variable consideration. Now, if the consideration promised in a contract includes a variable amount, an entity must estimate the amount of consideration to which it expects to be entitled in exchange for transferring the goods or services that has been promised to the customer. Let's test our understanding here. Sados Co. sells a car to a customer for $100,000, offering interest-free credit for a 3-year period. Now, the car is delivered to the customer immediately. The annual market rate of interest on the provision of consumer credit to similar customers is 5%. So we have to determine the transaction price. Sados is selling the car for $100,000. The car is going to be paid after 3 years with no interest charge. Now, because there is a difference between when the car is transferred, which is immediately, and 3 years, there is a component of significant financing. So this $100,000 has to be discounted from the 3 years time which will be received to the time the car was transferred, which is immediately. So at 5%, the transaction price will be $86,383.76. So you divide the 100,000 by the 1.05, which is compounding figure for the interest of 5% raised to the power 3 because it's 3 years. We move on to the fourth step, which is allocating the transaction price to the performance obligation in the contract. So the transaction price must be allocated over each performance obligation on the basis of the relative standalone selling prices of each distinct goods or services promised in the contract. Now, if a standalone selling price is not directly observable, the entity will need to estimate it using the following methods. The first of which is adjusted market assessment approach. So here, the entity evaluates the market in which it sells the goods or services and estimating the price that a customer in that market will be willing to pay for those goods or services. This might also include referring to prices from the entity's competitors for similar goods or services and adjusting those prices as necessary to reflect the entity's cost margin. The second is expected cost plus margin approach. So here, the entity will estimate the cost of satisfying the performance obligation and then add an appropriate margin. The last approach is the residual, permissible in limited circumstances. It involves estimating the standalone selling price by reference to the total transaction price and then deduct the sum of the observable standalone selling prices of other goods or services promised in the contract. Now, where a customer receives a discount for purchasing a bundle of goods or services, the entity must allocate the discount proportionally to all performance obligations in the contract, which means that it is allocating the transaction price on the basis of the relative standalone selling prices. However, if there is observable evidence that the entire discount relates to only one or more, but not all performance obligations in a contract, the discount is allocated to those performance obligations. So let's test our understanding. Optech Limited is a business that sells air conditioners, including installations, and a 2-year repair and maintenance package for $10,000. Now, the price of air conditioners alone is $9,000, installation $1,000, and the price to renew the 2-year maintenance package is $2,000. So how would the $10,000 contract price be allocated to the separate performance obligations? So when we look at the solution, the total standalone prices will give $12,000. Now, allocating the $10,000 to the performance obligations, the way we go about it is to pick the standalone price of the air conditioner and find its relative price to the contract price. So the air conditioner is $9,000 divided by the total of the standalone prices multiplied by the transaction price, which will give $7,500. We pick the installation, which has a standalone price of $1,000, divided by the total standalone prices, which is $12,000, and multiplied by the transaction price, giving $833.33. For the maintenance, we pick its standalone price of $2,000 divided by the total, which is $12,000, multiplied by the transaction price, giving $1,666.67. Now, after we have identified the contract, we have identified the performance obligations, identified the transaction price, allocate the transaction price over the performance obligation, we now go ahead and recognize the revenue. You do so by ensuring that the performance obligation is fulfilled. Now, the performance obligation is fulfilled when control is passed to the customer. Control is deemed to have been passed to the customer when the asset is used to produce goods and services by the customer, or the asset is being used to enhance the value of other assets of the customer. The asset is either being sold by the customer. The asset is being used to settle liabilities or to reduce its expenses. The asset is being sold or exchanged for other assets. The customer has pledged the asset to secure a loan or holding the asset. Performance obligation is fulfilled at a point in time when the entity has a present right to payment for the asset. The customer has legal title to the asset. The entity has transferred physical possession of the asset to the customer. The customer has significant risk and rewards related to the ownership of the asset, or the customer has accepted the asset. It is fulfilled over time when the customer simultaneously receives and consumes all of the benefits provided by the entity as the entity performs it. The entity's performance creates or enhances an asset that the customer controls as the asset is created, or the entity's performance does not create an asset with an alternative use to the entity, and the entity has enforceable right to payment for performance completed to date. So let's test our understanding. Uptech Limited is a business that sells air conditioners, including a combined contract of installations and a 2-year repair and maintenance package for $10,000. Now, the price of air conditioners without the combined contract is $9,000, installation $1,000, and the price to renew a 2-year maintenance package is $2,000. Now, if Uptech sold an air conditioner and a combined contract on 1st January 2017, demonstrate how the transaction will be presented in the financial statement for the year ended 31st December 2017. So, the signing of the agreement, which we deem happen, signifies the presence of a contract. So we have 3 performance obligations here: sale of the air conditioner, installation, and the maintenance of the air conditioner. The transaction price as stated is $10,000. So from the test of understanding of allocating transaction prices, we allocated $7,500 for the sale, $833.33 for the installation, and $1,666.67 for the 2-year maintenance package. So when we are to recognize revenue, we will charge $9,166.66 to revenue, which will be the allocated price for the sale and installation, which happened within the year. Then half of the maintenance, because it is 2 years. Then we come to the statement of financial position. Then the other half will be in the current liability as deferred income. Now, if a performance obligation is transferred over time, the completion of the performance obligation is measured using either the following methods. The output method. So revenue is recognized based upon the value to the customer. That is work certified. So the formula will be work certified to date divided by the total contract revenue. Or the input method. So here revenue is based upon the amount the entity has used or incurred. Example, labor hours. So the input method will be cost to date divided by total estimated costs. Let's test our understanding. So Alex commenced a 3-year building contract during the year 31st December 2019 and continued the contract during 2020. So the details of the contract are as follows. So contract value 45 million. We have cost incurred to date as of 2020, 20 million. Estimated cost to completion is 12 million. Work certified as completed in 2020 is 15 million. So stage of completion as of 2020 is 70%. And profit recognized to date as of the end of 2019 is 3.3 million. So we have to show how this contract will be dealt with in the statement of profit or loss for the year ended 31st December 2020. Okay, so when we come to the solution, the revenue to be recognized for the year 2020 is 50 million. That is the work certified for that year. So the cost will be the balancing figure. So we have to first estimate the profit. So when we look at the workings to the right, the contract price for the project was 45 million. Total cost, that is the cost incurred as of 2020 and the further cost of 12 million, giving 32 million. So the profit for the entire project or contract was 30 million. Now, we have been given the stage of completion as of 2020 to be 70%. So when we strike 70% of the 13 million, it will give 9.1 million. Now, out of the 9.1 million, 3.3 million has already been charged to 2019 from the question. So the profit attributed to 2020 is 5.8, which will lead to a cost of 9.2 million when we take the 5.8 from the 15 million. Let's test our understanding again. So Principal commenced a building contract in 2020. that has seen large increases in future costs to complete. Now, the contract will still be completed on schedule in 2021. The details from the year and the 31st December 2020 are as follows. So total contract price is 40 million. Cost incurred to date is 25 million. Estimated cost to completion is 20 million. Stage of completion is 45%. So we have to show how this contract would be accounted for in the statement of profit or loss for the year ended 31st December 2020. For the solution, we recognize a revenue of 80 million, which is 45% of the 40 million. That is the certified work completed for the year 2020. The cost also will be the balancing figure. So we look at the workings. Total revenue was 40 million. That is the entire contract price. Total cost is 20 million. That is incurred to date plus a further 25 million to complete, leading to a loss of $5 million. So when we bring the 5 million here, the cost is 23 million. Because there was a loss, we have to add the 5 to the 18. And because the loss has come in here, we recognize the entire loss to 1 year. Let's take a look at contract cost. Now, incremental cost of obtaining the contract must be recognized as an asset if the entity expects to recover those costs. So for it to be so, the cost must relate directly to the contract. The costs generate or enhance resources of the entity that will be used in satisfying the performance obligations in the future. The cost must be expected to be recovered. People, this is where we are going to bring our lecture to a close. If you have anything that you want us to expatiate on or have a feedback or comment for us, feel free to drop it in the comment section below and we'll be glad to address it. Whilst at that, kindly click on the red subscribe button, click on the notification bell by it, like and share. So we'll come to you by way of tutorials on the go. Take care of yourself and stay blessed. Poker.